This is your weekly mortgage brief, a quick snapshot of what moved markets this week, what stayed steady, and what's actually relevant if you're a homeowner or thinking about becoming one. There's no shortage of headlines right now. My role here is to help separate signal from noise so you can make more informed choices without reacting to every news cycle. So here's what stood out this week. This week brought plenty of noise, trade headlines, political tension, and ongoing global uncertainty, but very little actual movement in mortgage rates. Bond yields drifted slightly lower at times, mostly due to softer economic data and ongoing caution in financial markets. Job numbers in both Canada and the US were mixed, not strong enough to push rates higher, not weak enough to force cuts. The takeaway here is simple: markets are watching volatility, they're not reacting to it. Kevin Warsh has been tapped to replace Jerome Powell as U.S. Federal Reserve Chair when Powell's term ends in May. Now, despite all the headlines, investors were relatively comfortable with the announcement. Bond yields actually dipped slightly afterwards, suggesting this was seen as a stabilizing choice rather than a disruptive one. Why does this matter for Canadians? Confidence in the US Federal Reserve helps anchor US inflation expectations. That stability spills over into Canadian rates as well. On the regulatory side, OSFI confirmed it will keep both the mortgage stress test and the loan to income framework in place. There had been some speculation last fall that one might replace the other. It's not happening, at least not for now. Practically speaking, this means qualifying rules remain unchanged, even though arrears remain well below long term averages. And of course, the Bank of Canada held its overnight rate at 2.25. That was expected. And it keeps the prime rate at 4.45% for the third straight month. The bank expects inflation to stay close to target this year and noted that slower population growth and improving housing supply are helping ease pressure in the housing market. Markets barely reacted, which tells us expectations didn't really change. What does this mean for mortgage decisions? Rates aren't doing that much right now, and that's not a bad thing. This is an environment where certainty, structure, and flexibility matter more than trying to time the next move. That's all for this week. Thanks for watching.